Hello, everyone. This is Matt Curfman with the Richmond Brothers here for a February edition of Matt's Minutes. Thank you so much for tuning in to listen. I'm actually recording this on Valentine's Day. So, with that respect, sending lots of love and hugs out to all of you. Thank you for being part of our Richmond Brothers family. Well, there's lots of uncertainty still out there in the markets, in the economy. The main points I think that are causing, or we think are causing the uncertainty, have to do with the idea that the Federal Reserve is going to start raising interest rates this year. There's obviously geopolitical tensions, Russia, Ukraine. There's also still global supply chain issues going on, and also inflation. And then we are coming up next month on the 2-year anniversary of COVID kind of unfolding in the U.S. And in the U.S. markets. 2020, March of 2020 seems like a lifetime ago, but we are hitting 2 years. I've talked to several clients over the last week, and we kind of all agreed. We remember back when COVID was first coming out in the U.S., everyone anticipated it would be flu-like, and by the time summer came in 2020, it would be in the rearview mirror. Little did we know, and here we still are managing through that. So lots of things going on. If you look historically, I think the biggest turmoil in the market has to do with the Federal Reserve raising interest rates. According to UBS Financial Services and also the Federal Reserve website, if you go back to 1954, there have been 13 cycles where the Fed has actually raised interest rates. And contrary to current popular belief, 11 out of those 13 cycles have ended up in positive returns in the stock market. I'm going to say that again. 11 out of 13 of those cycles since 1954 have ultimately ended in a positive return in the stock market. So that seems to be the near-term concern as the market falls off every time we talk about rising interest rates. Keep in mind, the bottom line is that under most circumstances, we see the Federal Reserve looking to start increasing the short-term rate, quite honestly, because the underlying economy is doing better. So let's just kind of keep that in mind and keep that on the radar. As we keep moving forward, we are seeing corporate earnings get better and better, and ultimately that is another driver of just stock market performance. Obviously, we're looking at the Dow, the S&P, the NASDAQ, even kind of the core bond market, AGG. And really, if you look percentage off of highs and year-to-dates, they're still really quite negative. Bonds are down as far as a broad benchmark, about 4% off their highs. When you look at the Dow, the S&P, the NASDAQ, it's anywhere from 4, 8, 10, 12% ranges. And that's all happened just since January 1st. So we're not out of the woods yet. That said, for those of you that have safer assets or maybe lower risk scores, remember the scale is 1 to 99. The closer you are to 1, the more stable you are. The closer you are to 99, the more risky you are. As a side note, we Richmond Brothers are getting closer to being able to release your risk scores as a dashboard within your portal login. And so that's something we've been working with both Black Diamond and also Riskalyze on. So we hope in the first half of this year that is something we'll be able to do, so you can always just see your risk score each time that you log into your portal, and then we can use it as a tool to continue communicating. So pay attention to that. If you have questions, please let us know. We are here for you. We're here to help educate, inform, guide, and influence your financial decisions no matter what is going on in the world or with any individual holding. So don't hesitate to reach out. In the meantime, thank you so much for tuning in, and make it a great day.